John, a £584 million rights issue this week, launched by Hammerson. What sort of assurance you can give investors that this isn't maybe the first of other rights issues to come further down the track?
Well, clearly the issue as to why we needed a rights issue is very important. And the first point to make is that Hammerson is a very high-quality portfolio, prime assets, well let, and because of our development programme, we've actually got a robust and growing income. So we've got one problem, and that one problem is the extraordinary decline in values. The outward yield shift as a result of the credit crunch is pushing us up against our debt covenants. The question is, what do we do about that? Just to define that problem for you, our gearing at the start of 2008 was 57%. I think most people thought that was pretty comfortable. We saw a 6.5% decline in values in the first half, and that took gearing to 77%, and still within a range where I don't think anybody thought it looked a great stress in the business. And then we saw the extraordinary events of the final quarter of 2008, a 15% further decline in value. And despite the fact we sold nearly £250 million worth of property, we ended the year with gearing at 118%. Now that compares with our gearing covenant of 150%, our tightest gearing covenant in some of our bonds and in our bank debt. So what further decline from 118% without any sales would cause us to have a problem, be up against the pressure of that covenant? And the answer was about a 10% decline in value. We, the board, thought that was a risk being in that position, and as a consequence, what we were going to do about it, and we clearly came to the conclusion that a rights issue was the right answer.
Did you discuss other options? I mean, I know you've been trying to sell assets as well, of course.
Absolutely right, and clearly this is not an event that suddenly came upon us when the valuation dropped on the mat, so to speak, at the end of the year. So we could see there was the outward pressure on yields during the course of the third and fourth quarter of last year, and we embarked upon a major sales programme. We have been marketing both Bishop Square in London and Cartier in Paris, and we've been talking to interested parties who are in funds, not just about those assets, but also being prepared to talk to them about one or two other properties. The conclusion we reached was that by quarter four, the market was virtually frozen over. We'd had discussions at an advanced stage, and particularly with Cartier, I think well reported in the press that it was close to exchanging contracts to sell at an acceptable price. And that deal failed at the last moment. And there were very, very few transactions in the marketplace, as you can see, in the fourth quarter. The board reached the conclusions that to rely upon sales to mitigate the issue of the gearing coming up against our borrowing covenant would, given that they were uncertain and the negotiations were protracted, was the wrong answer. And that pointed to a rights issue. The second option that I think people would be keen to know we thought about was, well, what about going to the banks, to the bondholders, and renegotiating that covenant? Now, I think the first point to make is that negotiating covenants with bondholders is extremely complex and likely to be expensive. Just looking at the bank debt for a moment, it's on very favourable terms. We're actually borrowing over £1 billion on a coupon of 37.5 basis points over LIBOR. Now, we didn't go to the banks and say, can we renegotiate? But from the deals that are being done in a market, I think there's 2 points to ask yourself. Would £1 billion have been available for Hammerson? And I think the answer would have been no. I'm not sure £1 billion is available for anyone in this market. The banks are very constrained in their lending. And secondly, if it were to be available, at what price would it be? We came to the conclusion that that pricing, up from to whatever it would be, from 37.5 basis points, would result in a massive transfer of value from our shareholders to the banks, and therefore that pointed us back to the fact the right answer for shareholders was a rights issue.
All right, so you've explained how you've gotten to where you are today. If values were to drop from here another 25%, you may be in the same position. Is that a fair assessment?
That's, with absent any sales, that's about right. Now, I think there's two things I'd point to. If that was to be the case, then the drop in our portfolio, peak to trough, would be around 55%. Now, I know people are talking about the potential of a 50% peak to trough drop in IPD, but I'd make two comments. Firstly, we have 40% of our portfolio in France. I think most people do not expect France to be hit quite as bad as the UK. And so clearly that points to better performance than that 50%. Secondly, I think most people would understand that our portfolio was better than the median of IPD. Indeed, I describe our UK portfolio as being very much in the top quartile of IPD. So I think there's two pointers as to why we might reasonably expect to outperform on any IPD measure. So I think without sales, that 54% gives me considerable comfort. The second point I'd make is that if we do see a further dramatic decline in value, however dramatic, that will not be in a matter of a month or two. We saw 20% decline in value over the whole of 2008. If we saw the same decline in 2009, and I know pessimists think it could happen, but I don't get a feel that most people think it will happen, then that still gives us the rest of the year to prosecute sales, and indeed into next year if the decline continued then. As I said, this rights issue doesn't mean we're going to stop the sales programme. It very much continues, and we do have interest in both the buildings I mentioned, and I would be hopeful and optimistic indeed that we would achieve a sale in the first half of this year. Now, I appreciate there's a bit of a dichotomy saying sales were impossible with a frozen over market last year. Why have I got a bit more confidence? Well, I think you can see some clear pointers in the market. We've seen announced this week the sale by British Land of a significant stake in Meadowhall, and another transaction where London and Stamford were involved in a city office. And I'm sure you know of others, and I certainly know of others that I believe are taking place. So I think my read would be values have declined a bit since year end. We said that in our prospectus, that we expected values to continue to decline, and I think they have a bit. But I do think that there is signs of some thaw, and therefore a confidence that we will be able to prosecute a sale or two during the course of the first half of this year is realistic rather than over-optimistic.
Are you leaving yourself enough room to manoeuvre? I mean, it does sound like you're relying simply now on sales after this rights issue. Do you have any other options outside of that?
I think property companies have always, for growth, relied upon asset appreciation and or recycling capital. We are not a vastly cash generative and cash retentive business. If you look at the cash flow from our properties, it goes three places. Firstly, there is a significant element of interest that goes to pay the provider of our debts, the banks and the bondholders. Secondly, there's the dividend, which goes to our shareholders as their return on equity. And thirdly, and a very small bit, of course, is the overhead, the management of the business by the staff here at Hammerson. So when you take those three elements, there is not a significant amount of additional profit retained in the business, and therefore the model for property investments companies generally, and Hammerson is no different, that we take the business forward with growth by either recycling capital or in times of capital appreciation, an opportunity to increase borrowings whilst maintaining a prudent gearing level.